Thanks, Kelsey. I appreciate it. So I'm Todd Koch. I'm a partner here at John Knutson and Company. And one of those people that's moved around a lot. That's right. I've had, not only have I never changed careers, I've never changed employers. This is my 40th year there. And I work with Luke. So Luke, do you want to tell him a little bit about yourself?
Yeah, I'm Luke Palmer. This is my fourth year with JAK, so I'm relatively new to the industry. This has been my first job out of college, and I really love what I'm doing, and I love helping people. So this is just a great opportunity. Thanks for having me.
So we're going to try and cover a lot of stuff. And our goal is to give you enough information so you have an idea of what's out there, and the details will kind of fill in later. As an example is when you look at what we're going to expect today, so we're talking a little bit about the filing season, these economic impact payments or the checks you've been receiving, paycheck protection program, business issues, some individual stuff, state issues, future changes. In other words, we could be here for a really, really long time. So our goal is just to hit highlights so you have an idea of what you need to know. So like, for example, the paycheck protection program, we're doing an hour just on that. On Monday, we're doing an hour on just one segment of the business issues for the retention credits. So if you feel overwhelmed, you should, because we do too. Yeah, there's so much going on, and so we're just trying to give you an idea of what's going through. This is our goal here today, and hopefully we can help you through that. So Luke, why don't you go ahead?
Thanks, Todd. So the first thing we're going to talk about is the 2020 tax or 2021 tax filing season. There's a couple changes this year. One of the bigger things is that the tax filing season, the e-filing won't open till February 12th. In years prior, it opened about mid-January. This is as expected because of the tax changes that happened in the last week of December. As you know, Congress had that 5,000-page bill and it went through, so they're still updating for the changes. Also to note, if you have an earned income credit or a refundable child credit, you will not receive that refund till the first week of March. You can paper file earlier, but this will slow down your refunds because basically it just goes in a stack and they just pull off the top. As of right now, the due date is still April 15th, but we will be monitoring that, and I would recommend that you keep monitoring that as well.
Yeah, and on that stack of refunds, keep in mind, they're not even going to start looking at the stack until February 12th. So that's why everything will be delayed. So please do not paper file unless you have a reason to.
So next is the economic impact payments or the stimulus checks that rolled out. There was 2 rounds of stimulus checks. The first one was for $1,200 for both taxpayer and spouse, and you should have received that in April, as well as there was a dependent child care credit of $500. The second round, which came out this January, was for $600 for each taxpayer and spouse, with an additional $600 credit for dependent children. The first payment was either based on your 2018 or 2019 return, depending on if you had filed your 2019 tax return when the payments started to roll out. The second payment will be based on your 2019 tax return. So one of the reasons we're bringing up this point is you may not have received the full $1,200 or $600. That's because there's phase out amounts. So if your income, married filing joint, was over $150,000, the amount started to phase out, and it was fully phased out where you wouldn't receive any at $174,000 of adjusted gross income. And same for the $112,000 phase out for head of household and $75,000 for individuals. One of the additional credits this year is the recovery rebate credit. So if you didn't receive the full payment of $1,200, you could be and $600, you could be eligible for an additional credit on your 2020 tax return. Also, if your 2020 income was lower than your 2019 income, and based on your 2020 income, if you would have received the full stimulus payments, then you would be entitled to an additional credit. So the stimulus payments are not taxable. This includes the $1,200 check that you received or the phase out amount, as well as the $600 payment that you received in January. However, if you received unemployment checks, both state and federal, these will be taxable and you will need to add them to your tax return.
So keep in mind, as Luke said very clearly, you can get potential additional money on your return if you didn't receive the full payments during the year. But you will, if your income for some reason really went up and you wouldn't, it means you would have got less. No one, you or anyone else, has to pay back any of the amounts they received if they would have been phased out. So please don't be concerned that way. It's just an opportunity to maybe for you to get additional funds, not have to pay something back. So those checks, as you notice, all went to people, didn't they? And people that didn't have to file, there's ways you would have got money too. And if you didn't get that, you can go back and file. But that's again for people. Well, there's another section of that was for what's called the Paycheck Protection Program, or PPP loans, which went to businesses. In other words, we have to keep the businesses alive so there's jobs to come back to. So that's a big part of what the PPP program is. So there was an initial round of money that came through this last summer. Well, effective at the end of the last Sunday in December, there's now a round 2 of those loans. So the reason we want to bring this up, whether you own a business or not, one of the people that quite often didn't realize that they qualified are sole proprietors. So if you had a business and your business was, say you're selling firewood to all the tourists that are coming up there, right? And you just did that as you went along, and you weren't selling as much firewood this year. Well, what happened is you could apply for a loan based upon your 2019 income, and a lot of this loan would be forgiven, again, to make sure that businesses are around so that there'll be jobs going in the future. So please, if you or your friends have a small business, I don't care what it is, and you may be eligible for this funding, and that's why round 1 is open again. It closed in August, it is back. There were some rules that changed during the application process for PPP funds. A big part of that was partnerships, but also certain farmers, some of the rules changed. Or people that were confused about whether or not they're eligible for the loans may have paid back their loans. Some of those people can get money back. Also, there's some new nonprofits that can apply. And one of the big groups are called 501c6 businesses, but the easier way to think of it, outfits like the Kiwanis or Lions. Okay, people that are more group oriented. Those people can also apply for these funds. Now, this new round 2 is focused more on businesses that were impacted by the shutdowns. So to apply for additional funding for round 2, you have to show that there was actual decline in gross receipts in a calendar quarter in 2020 relative to the same quarter in 2019. So It doesn't mean that your overall income for the year had to be down by 25%. What it means is a calendar quarter in 2019 compared to the same calendar quarter in 2020. The 2020 amount is 25% or more lower. If that's true, you can apply for an additional loan. And that loan is based upon 2.5 months of payroll. If you're a restaurant or hotel, you can apply for 3.5 months of payroll, because those businesses were a little were quite impacted by the shutdown. So they're targeting a little more help there. And also with these loans, you can get these loans, but they are most often forgiven. And for most of the loans are 150,000 or less. The math I saw is about 75% of the loans were 150,000 or less. So they're trying to make a simpler forgiveness form. So if you have a small loan, just hang tight. They're going to make the forgiveness much easier. It's written that must be a one-page form. It's written that you don't need to provide all the documentation. You have to certify that you did spend the money appropriately. There's also some information about economic impact disaster loans or EIDL loans. That's a separate program. There's some interplay there that was a problem. These things have been addressed. I know I'm going through this quite fast, but I want to make sure we can get to your questions. We want to make sure that we can make big part of the concepts available to you. The PPP loan itself, the forgiveness is not taxable income by statute for federal purposes. What they're also saying by statute now, the expenses you paid with this loan are deductible. That is a change. And some people are calling this double dipping, meaning you got the loan for free. Now you're deducting the expenditures. I tend to look at it as additional business stimulus. Remember, what is the purpose? The purpose is to keep America's small businesses open. So they could have given you more money and had you not deduct the expenses, or they give you less money and allow you to deduct the expenses. Mathematically, you get to the same spot. So that's the way I tend to look at it, is try to get the stimulus to the level that they expected. One of the major changes for what we're seeing for people are what are called employee retention credits. English is if the business held on to people, because that was part of they wanted people to hold on to people and continue to pay people, even though things were very uncertain and the times were not as good. Originally, you had a choice. You can get the PPP loan or the credit. We had basically every one of our clients apply for the loan. That was better than the credit. What changed now is that you can get the credit and the loan. Again, it's really additional business stimulus for the people doing the right thing and keeping people employed. Also, they extended this credit to 2021. This credit is kind of complicated, so just realistically, the real takeaway is if you, for 2020, you need a reduction in your revenues by 50% or more in a calendar quarter. Very significant reduction. If that happens, then you can get a credit for people that you paid during that time. For 2021, the credit is back. It's a higher percentage than 2020, but the decline, not only is it a higher percentage, but the decline in gross receipts is smaller. So we're expecting far more use of the employee retention credit in 2021 than there was in 2020. So for you, those of you that actually may have a small business, I'm a small business owner myself, and we know what it's like to keep people employed. If you know people or yourself, this is another tool that's available to make sure we're around so that there's jobs for people to come back to. when you look at forgiveness for the PPP program, it's based, you have to look at how much you paid in wages and and then it's rent, utilities, and interest on real estate. You can look at these things, but you have to pay so much on wages. The wages you use for retention credits, you can't count for forgiveness. It just means it's complicated. So just as you're walking it through, just take your time and seek help when you need help, because there's more tax changes in the last 14 months than I can remember in my career. Because they also did a few other things here. They corrected a drafting error in the Trump tax bill, the TCJA, that allows that if you had a building and you reconfigured it so that you can make, so it's useful inside, like a normal tenant improvement. That's really what most of qualified improvement properties are. There may be an opportunity for you to write things off much quicker because of fixing this drafting error. Doesn't work for the 3 E's, elevators, escalators, and expansions, but it does work for a lot of things when you do inside the building. So you can't make it bigger. Put in an elevator, bless you. And but there's a lot of things in between that do qualify. And if you're like a lot of our clients, 2020 is not a good year, and they may have losses in their, and if these losses are in your business, there's a potential to carry these losses back for 5 years. It's kind of funny, in 2017, they said, okay, no more loss carrybacks in 2018 and forward. So now in 2020, they said, okay, now you can carry things back for 2018, 19, and 20. So it gets back to one of my golden rules. Tax laws are permanent until they change. So they're already changing things going back, but we did have quite a economic change here. And so it's allowing people to get back money that they previously paid. Should you go back? Should you go forward? Like all good tax answers, it depends. So kind of take a look at your own situation, see what's best for you, and figure out what you want to do. So Luke, what about some of the extended changes, extenders that they continually put back in?
Yeah, so this is the extenders bill that rolled out at the end of December, that 5,000 page document. There were a couple of changes, a couple of things that were extended for a couple of years, and then also, like I said, also some permanent changes. So a couple of the permanent changes were the medical expense deduction on your Schedule A, or your itemized deductions. It is at 7.5% of your AGI. It was supposed to go to 10%, but they permanently extended it at 7.5%. So basically, if any medical expense over 7.5% of your adjusted gross income is eligible to be put on your Schedule A. They also extended the 179D, or the energy efficiency improvements. So this involves more commercial and real estate property. So if a real estate developer was to go in and make a chain of energy efficiency improvements, say solar or something like that, they would be eligible for an additional credit. One of the things that was modified but not extended was the learning credits. So the American Opportunity Credit and the Lifetime Learning Credit, their phase outs are now at the same AGI levels. In prior years, they phased out at different amounts. And so going forward, these phase outs will happen at the same level. Whether you take the American Opportunity Credit or Lifetime Learning Credit depends on if you're helping out someone with education expenses, or if it's your first 4 years of college.
Mhm.
If in years past, if you didn't qualify for the American Opportunity Credit or Lifetime Learning Credit, you were still able to take a deduction for some of these education expenses. Going forward, you will no longer be eligible for those education expense deductions.
So kind of watch for the lifetime learning credit. I think that's one of Kelsey's favorite provisions in the tax bill, I think. So think of the things that you can do through through the CCHE that some of their classes actually will potentially qualify for the lifetime learning credit. It does not mean you're necessarily going for a degree. It is lifetime learning. It is a different thing.
So a couple of these were also extended through 2025. The Work Opportunity Credit. So this is a federal credit for employers who hire certain targeted groups that have seen employment or have issues getting a job or things like that. Also, you can exclude debt forgiveness on your principal residence, but it is limited to $750,000 per return. Empowerment zones were also extended. So this is for employers who hire in economically depressed areas. There is some availability for additional credits there. Also, if employers pay for family and medical leave, there's also the credit, a tax credit for that is also available. And you can exclude income off of employer paid loans. A couple of additional extenders. The mortgage insurance premium deduction was extended, and this will go on Schedule A. So underneath your interest expense will be a line for mortgage insurance premiums, and that's where you can pop in how much you paid for mortgage insurance premiums. Also, the home energy credit was extended. This is a lifetime credit. Say I put in new windows and doors and it makes my house more energy efficient, I would be eligible for this credit. However, if you've used it in the past, it's only a one-time use. So once you use up all the credit, you don't get any further deduction. Also, the non-itemizer charitable tax deduction. So in prior years, in order to deduct your charitable giving, you had to qualify for the Schedule A or the itemized deduction. Now you are eligible for this $300 deduction. It is $300 regardless of if you file single or married filing joint or head of household. It's just a $300 flat deduction. Also, you have unlimited cash charitable contributions. So in prior years, you were limited to 50% of your adjusted gross income that you could use as a deduction. Through 2021, you can give 100% of your AGI and it would qualify as a 100% deduction. And last, the solar and heat pump credit for individuals was extended. So this is if you put in a geothermal pump, you would be eligible for an additional credit.
There's a lot going on, a lot of changes. So what is old is new. It's tough for so what's going through there. How many of those will continue to go forward, we're not sure, but at least I'll give them credit. I appreciate them passing at the end of 2020 what's going to happen in 2021. It sure makes planning easier, assuming not more things won't change.
So one of the things we wanted to cover was the possibility of disaster relief provisions. So one of the things President Biden can do in the first 30 days of office is declare disaster zones. So if he were to declare Minneapolis a disaster zone because of the riot damage that happened this summer, some of these provisions would be eligible for certain individuals that were in the disaster zone. So these provisions include 10% withdrawal penalty on retirement accounts. As long as it's used for a qualified disaster distribution, this penalty will be waived. Also, there's special rules for recontribution of retirement plan distributions used for a home purchase in the qualified disaster area. In years past, you can take a retirement plan loan. It was capped at $50,000, but if you're in this disaster relief area, you can take up to a $100,000 retirement plan loan. And also, if you had disaster losses that were above and beyond $500, it is also eligible as an additional standard deduction.
So remember, all these rules are based if it's a presidential disaster area. No, people normally think hurricanes, earthquakes, floods, but in recent years you're seeing more smaller areas being declared disaster zones. So just not that we want disasters to happen, but just know that there might be some opportunity for some relief if it does.
A couple more changes that came were the meals expense. So this is a business expense. So in prior years, if Todd and I took a client out to eat, we would only be able to deduct 50% of the meal. So if it was $100, we'd only be able to deduct $50. In 2021 and 2022, if we were to take a client out to eat, we would be able to deduct 100% of the expense. Also, in calculating the child tax credit or your earned income credit, you can substitute your 2019 income for 2020 if 2019's income was greater than 2020. So this would allow for an additional credit. And finally, the flex spending accounts have an extended grace period. So the flex spending account is an amount that you set aside at the beginning of the year, and it has a use it or lose it policy. So if you don't use it by the end of 2020, then you would usually lose it. However, they have extended it, so now you have a 12-month grace period to use these funds.
There's going to be a test on everything Luke said there. So just, again, it's more to bring up the issues, at least to have you hear it once, so that when you hear it again, because filing season is just getting started, it'll give you an idea whether or not you feel comfortable that everything is there. Well, we have a couple other individual issues, but these are related to mostly people with businesses. And there's two groups that you have to look at that might have to file amended returns to take some additional losses. And that is some people that really lost a lot of money or significant dollars in 18, 19, or 20. Significant dollars we're talking are if you lost over $500,000, okay? If you have some very significant losses, there might be an opportunity to amend returns because your losses were capped in the past, how much you could really deduct. Also, certain businesses had some restrictions on how much interest they could deduct. Those restrictions were loosened from 30% of your income to 50%. So again, not a big impact to a lot of people, but if it impacts you, it can be a very big number. And since we haven't talked about made things complicated enough, we have our friends in St. Paul. So we talked about all these wonderful things that the government's changed. But in Minnesota, no federal changes can be adopted until the legislature passes a law. And this is not anything the legislature can change. It has to do with the Minnesota Supreme Court decision going way back to like when I first started. It's a very long time ago, where one Minnesotan took took the legislature to task, because we used to have it where everything was automatically adopted. And the person did not like the results. So he said, you know what? The legislature should have to make its own decisions. It should not allow someone else to make the decisions for them. And the Minnesota Supreme Court said, that makes a lot of sense to us. The Minnesota legislature shouldn't make changes just because someone else did. They should make their own changes. So because of that, some of the most significant tax bills we've seen have not been adopted by Minnesota. And be the Secure Act, that's the one that delayed your required minimum distributions to 72, and a few other things. Family First, which are the federal credits, and among other things, the CARES Act, which is had all the PPP loan stuff in it, and a bunch of other things to help with what's going on. There's been about 8 significant federal tax bills passed since Minnesota has, and Minnesota hasn't adopted any of them. I will give them credit. They did do one thing here in their multiple special sessions. They did agree to allow small business owners to write off their equipment under what's called Section 179, but just think of it as upfront write-offs of business equipment, be you a farmer or be you a retailer. They're finally allowing that. But looking at your Minnesota return may be a very daunting task. The Minnesota individual income tax return is called M1. The M1 is where you list, okay, here's my federal adjusted gross income, make some changes, calculate your tax on the back page of page 2, show your payments, balance due or refund. Then there's a Minnesota nonconformity schedule. It lists all the things that Minnesota does differently than federal. There are more lines on the schedule that lists what Minnesota does different than federal than there are lines on the form to calculate your tax. There are more lines for differences than there are lines to calculate your tax. That is how complicated things have gotten. So your results can be quite a bit different. And if you have a PPP loan, it's going to make some very significant differences, because remember, federally it's not taxed. For Minnesota right now it is. So that can make a big difference. So don't forget about our friends in St. Paul when you're doing your tax calculations, because they could be radically different, up or down. You just don't know. So now we're going to do what I spend most of my time here doing. What people say, well, Todd, I know where we are. I need to know where we're going. So you got to know the few rules why we look at what might be happening. 1, any prediction I give you, the result will be more or less than what we predict. It will never be what I say. Be like you predicting what your income is going to be going forward. Whatever number you say it's going to be, you'll do better or worse, but you won't do that. We're back to tax laws are permanent until they change. And boy, have they changed. They're going backwards, forwards. They have no problem making changes. They're making changes in mid-20, and they're backwards to the beginning of the year. But actions without consideration of the future will rarely lead you to the best result. The one thing I don't have on the screen, but is always a standard comment for me, is if my crystal ball was perfect, I'd be having this conversation from the Bahamas. That white stuff that's out my window out there is not sand. So with that understanding, I will let you know what I think. So one of the things that Biden has laid out is what he would like taxes to be. He thinks that the top tax rate should go higher. He thinks we should have more Social Security taxes on high earners. Capital gain shouldn't be as favorable for those that make a lot of money. There should be, we should be allowed to deduct more of the taxes paid. So that's a benefit to some people here in Minnesota. They would cap the benefit of itemized deductions to a 28% rate. In English, the way our system works is if you're in the top rate now is 37%. If you are in a 37% rate, $100 of deductions will give you a $37 benefit, 37% of whatever you deduct. One of the things is, well, we don't want anyone to get a benefit of more than 28%. So that means if you're in a 22% bracket, a deduction of $100 will drop your taxes $22. Say if you're in a 37% bracket, a deduction of $100 would give you a $28 benefit. In other words, it's based upon a percentage. There'd be additional tax credits for people with children. And for the first time that I can recall, a higher credit for children of a younger age. I've seen it at, right now at 17 and above, it's 0. Well, here, they're scaling the credit to actually higher when you're really young, then it'll drop a bit before it scales off to 0. Also, a possibility of reinstating the first-time homebuyers credit. That was some of the advances they gave during the Great Recession. Business taxes, they dropped. One of the big changes in the TCJA or Trump tax bill, whatever you want to call it, was dropping the corporate tax rate from 35% down to 21%. So he's looking, well, we should really increase that rate to 28%. Some additional minimum tax on very large businesses. There is a QBI, which is called qualified business income deduction. If for businesses that make a lot of money, they don't want to allow them that deduction. That deduction is put in place to get individual rates closer to business rates. Because remember, most small businesses the individuals pay the tax, not the business, because that income flows through to the business owner. It's a way to get those taxes closer. It's not, if you make a lot of money, you shouldn't get that. And then some changes on estate and gift taxes, where there would be as large of an exemption, no basis step up, a lot of things. So all this information I put in there, that was on Biden's website. So that if you want to know where the source is, there's a lot of things. But the question is, what really can happen? The president's opinion is very important, but the president alone, no matter who the president is, cannot change tax law on their own. And if you look right now, the president is a Democrat. The Democrats control the House by 5 seats. The Democrats control the Senate. Yes, it's 50-50, but I'm willing to bet the tiebreaker vote goes to the vice president, and I'm almost willing to bet she'll side with the Democrats. So it means the Democrats really control all 3 sections. But do the Democrats really control everything? I submit to you, no. So now let's talk about why. So I have a big bet with one of my partners here. John and I have a bet, Luke. It's at my maximum stakes. That's right, a cup of coffee and a donut. That I don't think I think there's gonna be a lot more giveaways, but I don't know there's gonna be a lot of tax increases. My logic has to do with that you need, because it's so close, in each of the sections, you need all the Democrats to agree. And not all the Democrats they're not quite as cohesive as the Republicans. I'm not saying right or wrong. What I'm saying is as a party. And how do you get in the Senate? There is one, my total thought process is relying on one person. There's a senator from West Virginia who's a Democrat and a moderate. So I don't know how you put all that together, but because he has said that if you look at the Senate rules, they're very arcane. They're very structured. Everything moves a lot slower. They have a thing in the Senate called the filibuster. Filibuster, when I went to school, was someone could stand up and talk about a bill for as long as they wanted to, right? They don't care. You could read War and Peace as your support for why we need more maple syrup on tables every morning, okay? It doesn't make a difference what the bill is. You could get up there and talk. Well, they're really lazy now. All they have to do is say, I'm filibustering. They don't have to stand up. They don't have to talk. Just like, okay, I'm filibustering. Let me know when you're going to stop, and then we'll remove the label. Well, the only way to get things to really move through quicker is to remove filibuster rule. The guy from West Virginia said, I'm not going to vote to get rid of filibuster. So now I have to have a West Virginia moderate Democrat agree with a certain Democrat, independent, but he votes with the Democrats from Vermont. That's quite a spectrum to get everybody to agree. So it's going to be difficult. So we're going to watch. The litmus test is going to come very soon. The way you'll know whether or not I'm more likely or my partner John is more likely to be correct is going to happen when they vote for the next round of stimulus. That's right. So as you know, that there was the $1,200 check, there was the $600 check, and then all of a sudden people said, oh, it should be a $2,000 check, right? They're going to bring up an additional $1,400 check coming up very soon. And they're already negotiating with the guy from West Virginia. He didn't really want to vote for it because he thinks it should be more targeted relief versus general relief. So we'll see where the land lies. So my prediction is, I don't think there's a lot of people saying, look at all these changes, you need to do a lot. They may be very right. They may be right. My personal opinion is I'm not expecting as much of a tax increase for the next 2 years. After 2 years, all bets are off because there are 36 Senate seats available up for re-election in 2 years, 22 Republicans and 14 Democrats. Remember, I'm putting all my eggs because of one person. If 2 more seats flip, one person's opinion doesn't matter as much. So we've talked about what has happened. We've talked about federal issues, state issues. We also talked about what could happen. And we did all that in 40 minutes. You probably got it all figured out. You probably don't have any questions. You got life all figured out. We
have questions in the chat already.
Well, that's good, because that's what I'm used to.
So what is the deadline for the PPP loan?
March 31st, or until the money runs out.
Perfect.
So right now, they're not expecting the money to run out super fast. Again, you don't know, but the amount is about half. Or about half of what it was, but the large loans disappeared. You can't get any more than $2 million, and it used to be 10. So we don't expect it to go as fast.
Great. And we have, how do you enter PPP loan forgiveness in business financial records?
Right now, after you get your notice from the SBA that the loan has been paid off, or you actually gets from the bank. It goes from the SBA to your bank to you. Then what we're suggesting to our clients is debit the loan, get rid of the loan, and show it as other income. By showing it as other income, that will then help you make sure you tax on it. I must have done something. Do I have an
Nope, you're
echo?
fine. Somebody unmuted. You're fine.
No problem. I just want to make sure I didn't do something wrong. Because also when you're looking at your reduction in revenues between years for some of the retention credits, the PPP loan forgiveness does not count as revenues.
The next question we have is, what do you think the simple form, or when do you think the simple form will be available for the first round of PPP forgiveness? Under 150K?
Yep.
And available, where do I access that from?
I believe the form, my opinion is the form should be ready by the end of the month. In the statute, it said they had 24 days to design the form. The form says it will only be one page. It will not require, all the things I put in there are from the statute. But there's so much going on. I'm kind of saying it'll probably be about the end of the month. The SBA has a great website out there. That's where I get a lot of my information from. So follow the SBA. They're really great. Also, if you want to, that's what we're dealing with is a little more at JAK. We'll be doing another seminar on Monday on this very topic.
And we will share out that link if Todd's willing to share it with me.
Mm-hmm.
So you can join that if you wanted to. Well, I would invite you to unmute now, and then you can ask any questions you want out loud. Yep, Francis, you have to unmute yourself.
I'm 90 years old and I didn't take any money out of my IRA this last year. Am I in trouble?
No, you're not in trouble. You actually followed the new rules. You just didn't realize you did. So for 2020, if you were more, you did not have, no one had to take money out of their accounts. For 2021, as the way the rules are today, you do. That's the gist of it. So you're no sweat, Francis. You're fine.
So what amount do I take out in 2021?
There is believe it or not, there's a brand new table for you. We could send Kelsey the table if you wish. I don't have it all memorized. It's a little bit slower than what it was, just a little bit. Why is it a little bit slower? Because people are generally living longer, okay? Well, when's your birthday, Francis? Because my father-in-law just turned 90. He was born.
I'll be 91 in March, so.
Oh, you're a year old? You're just, his birthday is in July. He'll be 91.
So when we get the new chart, we would use our current age.
Yes, use your age at December 31st. You look at your December 31st balance and you just kind of plop a number in. It's going to be about the same percentage as in the past, Francis. Okay.
So we do take it out. We do take it out for 21.
For 21, yes, you should. Mm-hmm. Unless you do the fancy where you can give it to charity direct from your IRA. You know what I'm talking about when I say that, Francis? There's a thing called a qualified charitable distribution that for people that are charitably inclined, instead of taking the money and then giving it away, you can have that money go direct from your IRA to the charity. That gets you to a better tax result. I could go through the math, but realistically, it's a good thing. You have to be over 70 and a half. So you qualify. It's something to think about, Francis. Your bank or whoever holds your IRA will definitely know how to do it, because very, very many people are doing it that way.
Okay, that's good. Thank you.
You're welcome to unmute yourself and ask questions at this point in time. So if you have any, or you can put it in the chat and I'm happy to read it off.
If you don't, one of the things that some people were talking about are home offices, because people had to weren't going into the office as much as they were. I didn't get to see Luke near as much this year. It was kind of a sad year for me. I didn't get to see Luke as much. Well, with home offices, if you're an employee, the gist of it is there's a potential small Minnesota benefit, but by and large, an employee with space in their home is not going to get any deduction due to changes in the tax law from 2017. The other thing to keep in mind too, we talk about Minnesota complications. There's two Minnesota benefits I want you to think about. One of them is, even if you take a standard deduction, Minnesota allows a benefit for charitable donations if you give more than $500. The amount you give above $500, half of that amount is a deduction in addition to your charitable, in addition to your standard. So that's something to watch for. It's been there for a number of years. The other thing that I'm seeing some people use in Minnesota, that's a Minnesota off deduction, has to do with 529 plans. I'm not a code head, but that's where you could potentially give money to your grandchildren's education account, and you can get a Minnesota tax deduction, and you help out your grandkids. So there's some new things. That's not new, but it's things that we often have to remind people of. And if you don't bring it to you, who's ever helping you do your return, or if you do it yourself and you're not aware of it, just some ideas for you. Boy, I have the most intelligent group here. You got everything all figured out. But realistically, probably the most important thing I can tell you to do is stay calm. Take your time. The amount of changes are very significant, but by and large, for a lot of people, not as much is going to change. Don't worry if you got your full stimulus payments. That's going to be one of the big things that's going to impact a lot of people here. If you got your full stimulus payments, don't worry about looking for that credit and all the muckety muck you're going to see on it. That's fine, because you don't have to pay it back. And you don't have to worry about calculating more if you got the maximum amount, right? So realistically, don't worry as much. Taxes can be very stressful, but we tell a lot of our clients what we're here to is to help reduce your stress. So the number one thing to do is don't impose that stress on yourself to begin with. Don't be like my father, who was worried about, he missed a tax deduction for $10. Like, Dad, it's $2. Come on.
Luke, would you mind talking for a second about unemployment, and for those that maybe had businesses and took unemployment as an employee for themselves potentially, or contractors that did unemployment, or any of those, as well as individuals, just how that might be impacting taxes this year?
Sure. So as we kind of stated, is that those unemployment checks will be taxable in 2020. So there was a 13-week period in which you could receive unemployment. So all those checks or benefits that you received would be taxable.
And that those that clicked on the button that said to take the taxes out ahead of time have those done, but if you didn't, you might be paying that, correct?
Right.
And furthermore, even if you click to have taxes taken out, they took no taxes out of the $600 checks. They weren't allowed to, so none of it came out. And if you
So that will be taken out additionally, is what you're saying?
You're going to have a balance due on your return, is what it is. Yeah, because you had a bunch of income without any withholding on it. Also, when you clicked to pay taxes on it, it was taxed at a very low rate. It was 10% federal, 5% Minnesota. There aren't many people that are in just a 10% bracket. So some of those people are going to be very surprised.
So if you saw maybe a contractor that is used to maybe putting some money aside because of the way they usually operate, would you be recommending that they put some additional money aside at this point, or at least be looking at their budget for that?
It's the latter, looking at the budget, yes. Budget for the interest-free loan that they have due April 15th. That's the way we describe extra tax payments is an interest-free loan until April 15th.
We got a couple more minutes, you guys. Any questions from the group? Otherwise, we'll say thank you to Luke and Todd. I see some conversations happening at some of your different locations. So is there anything that we didn't get covered today that you wish you knew more about?
Francis has got one more question.
Yep, Francis, you just have to unmute yourself.
There we go. You told us that the Minnesota tax laws were a lot different. So are they going to be mad at me for not taking out of my IRA this last year?
No, they're not. I don't see that happening. They understand the difference between some of the balancing things that are going on. I don't expect that to be an issue, because the cause for the problem with not taking it out is a penalty on under distributions, and Minnesota doesn't have that penalty. So no, I would not expect anything, Francis.
Okay, thank you.
Mm-hmm. Well, we appreciate everyone's attentiveness. We appreciate your insightful questions, and thank you for the opportunity, Kelsey.
Their pleasure. It's always good to talk with people from the cities. Bring them on up. Even if that's just virtually these days. We hope to actually see you up in Cook County in a COVID-freer world.
Thank you very much. We hope to be up there soon. Have a great day.
Looking forward to touching base with you. I will be sending out an email with the things that Todd and Luke mentioned. I would say let's give them a day or two, and then I'll look for that email to be sent after I get the information from them. Sound good?
Sounds good. Thank you.
Thank you for joining us, everyone. And thank you, Todd and Luke. If you were here, I would give you a round of applause, but I just say thank you.
Thank you.
And now I can end it.